In this video, we're really going to concentrate on risk analysis and capital budgeting. Of course, incorporating into that, there's also the concept of real options and what that adds to the complexity of making capital budgeting decisions. So let's first start talking about what we can use, what techniques are available. And we're going to discuss essentially three scenarios. We're going to talk about sensitivity analysis, scenario analysis, and break-even analysis. And what this process allows us to do is a couple of things. Number one, it allows us to incorporate some potential variability in our prediction, right? It allows us to incorporate some known parametric statistics, if you will, about our variables into this whole process. It also allows us to look at and determine how stable our estimates are, right? So it is a risk analysis. So here we have this company, they want to invest in a developmental drug, cures the common cold. So we've gotten together with a group. We've looked at all the different phases and components of operations, of marketing, etc. And we've decided that we're going to go ahead and we're going to test this process, this technique, if you will, or this drug. And we have to go through a development phase, right? So the first phase, this preliminary phase, is going to last a year. It's going to cost about $1 billion. And there's a 60% chance that the test will prove successful. If it's successful, then we can go ahead with a full-scale project. That's going to cost $1.6 billion. And that'll give us some production for over the next 4 years. So the first thing we would like to do is test whether or not we should even move forward with the preliminary test. So we have two potential outcomes. It could be successful or it could be unsuccessful. And here are the cash flows. The revenues we expect about, let's use 7,000, 3,000 in variable costs, 1,800 in fixed, 400 in depreciation. Gives us pre-tax profit of 1,800. There shouldn't be a percentage there. $378 is the tax, so we have net profit of $1,422. And when you add the $1,422 to depreciation, here's our cash flow. This is for years 2 through 5. So now how do we find the net present value? The net present value, if we are successful, is $4,175. So again, if we're successful, we should move forward. What if the worst case scenario happens? Revenues are lower, right? So in the end, we end up with a net profit of only $90. Add the 400 of that, 490. So for the net present value, if we're unsuccessful, is negative $44. So we have two values. One value if we're successful and one value if we're unsuccessful. So 60% probability of success plus 40%, that's the probability of unsuccess. So the expected payoff of cash flows is $2,487. So the net present value over the 1 year, right, for just 1 year, is $1,261. So what this says is the expected payoff at date 0, right, today, is $1,261. So that's our first step. It says, look, at least we should move forward with this project. So now, what did we find out about this project? If revenue drops by $1,000, right, the percent change in revenue is roughly negative 14.3%. If that's true, net present value drops roughly 59%. So for a 14% drop in revenue, we have almost a 60% drop in net present value. And if you do a little bit of simplification here, it says, look, for every 1% drop in revenue, we can expect 4.2% drop in net present value. What that tells us is that revenue is probably pretty important to understanding the analysis, the understanding the outcome of these particular projects. So here we have what we refer to as the best, average, and worst case. The worst case scenario is what we were just looking at. But the worst, is the average is what we've just been talking about. And now the worst case, instead of 10,000, we sell 8,000. Price goes down, labor goes up, material costs are up, cost of finance up. This is the worst case scenario. Here's the best case scenario. What we would like to do first, let's just calculate the net present value for these particular scenarios. So what is the net present value of units, price, labor cost? So if we go down, the analysis says, look, in the worst case scenario with units, if we only sold 8,000 units, we would have net present value of 29,000. Under the best case scenario, it'd be 216. What about price? And again, you can see we can calculate the net present value for each one of these potential outcomes. And then if we said, look, there's a 15% chance of the worst, 50% chance of the average, and 35% of the best, now we can do some statistical analysis on each one of these units. And we have a specialized a worksheet. It's called the Project Risk Analysis Worksheet. And again, you put in the probabilities. This is our standalone risk analysis that we've talked about in the past. And you just input the data that we gathered, that we calculated. These are the net present values. And if you remember, this was price, this were units, price, etc. So what this gives us then, it gives us an idea about the riskiness of each one of these net present values with respect to that variable itself. So here you see the let's look at coefficient of variation is the best. 0.44 is with cost, units, Price is 0.598, so it's more risky. The least risky here is the third of the categories here, which is the labor cost. And then the last three, or the last two, are equal, and that is, I'm trying to look at what that is. That is material cost and the cost of financing, right? So the last three are the least three risky. The first two are the most risky. So what this tells me as a manager is, certainly we have to be very diligent with our forecasting, but asset A and B are very, very important variables. Is very sensitive to the values that we input. It's very risky. So we want to put a lot of effort into forecasting units and price. The least of our worries should be the labor cost, because that is not going to dramatically impact our net present value if we're off a little bit in with that particular variable. So that's what's referred to as sensitivity analysis. Scenario analysis is where we're going to look at several things, right? It considers the effect of net present value by simultaneously changing multiple assumptions. So what if we change sales price and units? How does that affect net present value? Again, we end up with a range of net present values when we look at how sales units change. So this is, again, a range, if you will, of net present values. Can we find out, well, what is the price? If this is our price ranges, if you will, here's our average net present value. How can we find the units to sell? And this is actually done pretty easily with the solver function or with the what if analysis in Excel, where you set the price, set the net present value, and then ask it to solve for the units to get that. So what we can see here is that, based on the number of the sales price, the units we need just to get to the average net present value declines. But at 8 units, we need to sell 43,000 at $8. We need to sell 43,000 units. I mean, what is the possibility of that moving forward when in our best case scenario, we're saying 10,000? Is it likely we could sell? So $8 is not a price unit that we could probably match. So maybe it needs to be $16, $20, $16, somewhere in that range should be able to get us the number of units we need to sell to get to that average net present value. So scenario analysis allows us to change more than one variable. Sensitivity analysis really looks at just changing one variable. So I look forward to talking to you in the next video.